I would like to welcome everyone to today's webinar, The 7 Deadly Sins of Incentive Compensation. Acquiring, retaining, and motivate the right talent continues to top the list of challenges identified by CFOs and other C-suite executives at companies of all sizes. Incentive compensation plans that miss the mark can damage any company's profitability and even put the future of a company at risk. Today, our featured speaker, Eric Charles, will share with us the 7 most costly mistakes companies are making in terms of incentive compensation design and management as identified through the analysis of 8 years' worth of compensation data, literally billions of calculations from hundreds of companies. He will also share specific do's and don'ts for building effective sales incentives plans and actionable advice regarding how your company can leverage technology to attain the highest levels of employee motivation while avoiding risky accelerators that can wipe out company profits. I'd like to thank Exactly, whose commitment to thought leadership helps us make this webinar possible and delivered at no cost. A quick note on today's agenda. First, we'll hear a presentation from our featured speaker. Then we'll move to the interactive Q&A session where we will spend the remainder of our hour. We would like this to be an interactive experience for you. So if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. We can't promise to get all of them in, but we will do our best, and we'll follow up afterwards on any questions we did not get to. A few logistical notes about today's webinar. A link to today's presentation and video recording of the webinar will be sent out to all attendees within 24 hours of the event. Those who would like CPE credits will need to answer all polling questions during the event and should have pre-registered for CPE credit. For any questions on CPE credits, please send an email to cpe@performative.com. Again, we encourage you to ask questions on today's topic via the questions box in your GoToWebinar control panel at any time during the webinar. Finally, you'll be asked to take a short survey today regarding the webinar. We greatly appreciate your feedback regarding our event today, as we always strive to improve the ROI we offer our event attendees for their valuable time. A quick word about Performative. Performative is the largest online community and resource for senior-level corporate finance, accounting, treasury, and related leaders. Performative connects corporate finance leaders to provide instant advice and insights on the tough financial and strategic challenges they face every day. Let's get started by introducing today's featured speaker, Eric Charles, Principal Incentive Strategist, Exactly. Eric has over 20 years of experience working with sales and incentive compensation. He has designed plans as a consultant, managed them in both sales operations and as a sales manager, has been working on sales effectiveness software solution since the 1990s. Today, Eric uses this experience to help develop the next generation of incentive compensation solutions at Exactly. He also works as an angel investor, an early-stage company advisor, and is a charter member of the Deep Leadership Circle of the Paul Merage School of Business. With that, it is my distinct pleasure to hand the floor over to Eric Charles, Principal Incentive Strategist, Exactly. Eric, please take it away for us. Thank you very much.
Thank you very much, Ernie, and thank you everybody for joining us today. Should be a fun discussion. What I'm here today to talk to you about is the 7 deadly sins of incentive compensation. It's a perfect theme as we lead up to Halloween tomorrow, and hopefully you will not identify yourself too many times in this, but even if you do, I've got a few hints and tips on how to get out of it. So let's start by setting the stage for what we're talking about today. If we look at how companies are spending money, we find that they spend about $160 billion on advertising. And a matter of fact, I bet you if I came over to your offices and you'd let me take a look at your calendaring system, be it Outlook or Google or whatever you use, and I did a search for meetings to talk about the effectiveness of our advertising spend, I would see a lot of things on the calendar. And I'll bet you if I even went further and looked at, how often you had meetings and how many reports you were running on, did we get as much money out of that particular spend versus, another direction that we put a trade show versus a magazine ad or something, lots of meetings. Now, let's bring up the next one. Social Security, $778 billion. And as we know, there are tons of meetings about that at the national level. Sales compensation is more than $800 billion. It's more than Social Security. It's significantly more than advertising. But too many companies don't even bother looking at it. Or at best, here it is, we're at the end of October, coming in November, and maybe you're starting to schedule a 3 or 4 hour session to talk about designing next year's comp plans. That's why we're having this meeting today. Sales comp matters. It's a huge spend that impacts your bottom line, yet people don't spend enough time looking at it. Now let's go a little further on that. Why should we be looking at it? Well, we make some bad assumptions. This is a distribution of annual quota attainment. And you might say, Eric, where'd you get this great data? Well, it came out of Exactly servers. This is looking at several hundred companies tens of thousands of sales reps and how they brought in the numbers. And you can see it is not a normal curve. My old stats professor, Tom Eppel, would look at this and go, what in the world is this data set? It is not a normal curve. We do not have normal distribution. Anybody that assumes normal distribution is wrong. Instead, what we have is we've got a nice run up to 100% of quota there on the green line, a nice spike at above 100%, and then the big drop-off that keeps on going, as I like to put it, that's where the rock stars hang out. Understanding quota distribution alone is the type of thing I want you to be thinking about. You should be looking at your own quota distribution and seeing who's making the money, who brings the dollars in, and who doesn't. Where Exactly likes to come in is, we've got terabytes upon terabytes of data. And when I say a terabyte of data, I'm not talking about the stuff that takes a lot of space on your home computer because you shoot photographs. I'm talking about zeros and ones of information of comp plans, transactions, credits, commission payouts, bonus payouts, spiff payouts, deals won and lost, deals where the credits are split, etc. And we take all this data, we put it together, and the goal here is to help educate the marketplace on the better ways to spend all of those incentive dollars. I'm a firm believer in incentives. I've got tons of academic research backing me up on how incentives work. So now what I like to do is compare it to actual data we see in the Exactly servers. We're an 8-year-old company. We've been collecting all this information in an anonymized, aggregated fashion so we can bring you the education and learnings for today. But to start to kind of set the groundwork right now, what I'd like to do is go ahead and ask our first polling question. So, Ernie, if you could get that up on the screen, please.
Great.
See where our audience is.
Great. Thank you very much, Eric. Like you mentioned, we're going to go ahead and launch our first polling question. Our first polling question asks how often your company analyzes your incentive compensation performance. As a reminder, those of you after CPE credits today, for today's webinar, you will need to answer all 3 polling questions during the webinar. Of course, we appreciate everyone's consideration in answering all of our polling questions. We hope this question will inspire your questions, and we encourage you to please ask a question on today's topic at any time via the questions box in your GoToWebinar control panel. I'm going to go ahead and leave our first polling question up for another 15 or 20 seconds or so, and then I'm going to go ahead and close the polling question. I'm going to share those results with the audience, and then we are going to get Eric's comments on the results, and his comments on the results will help tee up the rest of Eric's presentation that he's going to deliver for us today. So I'm going to go ahead and close the polling question here. Okay, now I'm going to go ahead and share that polling question. And Eric, what are your thoughts here?
I wish I could say I was surprised. I'm very impressed that 10% of our audience is taking a look at incentive comp performance on a monthly basis. That is fantastic, and all of you that click 10% should give you a good pat on the back. Similar, actually, with the folks saying quarterly. I'm going to assume you probably have a quarterly goal, quarterly quota, some sort of a quarterly measurement. So at the end of the quarter, you're looking backwards at the prior few months. That's great. The half of you on annual planning, not good. You're waiting a little too long to look at it. And I can't believe that there's many markets left where the market only moves on an annualized basis. I know certainly here in our industry, we're dealing with changes to the market landscape almost on a weekly basis. Waiting till annual planning is going to get you in trouble. And as for those that don't even analyze, I think you know who you are. We don't need to go any deeper into that to be cruel. So with that, let's jump into the 7 deadly sins. And I'll walk through each one of these, show you, discuss the sin as it is, some of the challenges you should be watching out for, how you can know you've got a problem. And at the same time, I'm going to bring up ways to atone for your sins. We're going to keep a strong theme of taking care of all of that. So waiting for my, sorry about the screen to catch up. There we go. Sorry about that. So first sin, poor alignment with business objectives. This actually is very, very common. What happens is that you end up writing an incentive plan based on what you think you can measure and what you think you've got going, but it really doesn't tie up to what the company needs to get done. So then what happens over time, we go with something simple. We just need revenue. We just need revenue. And then over time, maybe you're in a price battle with the competition and margins start eroding significantly. But at the same time, you're trying to convince your reps to move into solution selling so you can maintain margins, but your comp plan still just pays on revenue. You have a comp plan that pays for just bringing in the deal regardless of the price point, but you have a strategic goal of improving margins. Or perhaps you've got a different goal. Your goal is new customers. You realize that what you've really been doing is feeding off of your existing customer base for a long time, which is nice, but you don't have any growth. But if your comp plan still just pays the same, a dollar is a dollar is a dollar, your reps are taking the easy way out. They just keep on getting some incremental business out of your existing customer base, but you're not growing your customer base in the slightest. This is where you hit this problem of misalignment, where the plan components tell the reps to do one thing, but the company goals are in a different direction and not in parallel with the plan components. So how do we fix this? Well, what you do is start taking a look at each one of the pieces individually and map them back to the business objectives. What I'd like to do in that direction is actually like to have a meeting on a quarterly basis, and it should have marketing in there, it should have products in there, it should have finance in there, it should have sales in there. And sit down and say, what are our goals for this upcoming quarter? They've already had this meeting. Now, what can we do to try and tie the compensation plan to those goals? So again, if the goal is we want to expand into a new marketplace, then we need to make sure the compensation plan is changed to better reward expanding into that new marketplace. If we are having some pricing issues where the reps are taking the easy way out and dropping the price as low as possible, then we need to add a component to pay off on margin. You want to, again, take it back and look, make sure you don't have a conflict in there, but go back and go through those business objectives. What I like to do is, I do a whiteboard exercise. We get everybody in the room, and we list up every goal for the quarter. And in a classic brainstorming fashion, you don't shut anybody down. You let everything get up on the board. Then at the end of the conversation, we start voting, and we come up with the top three. What are the three things? It might be nice to achieve all 20 of these goals, but we can't give 20 goals out to our sales reps, or they'll get confused. Which actually brings me to the next sin, and that is excessive plan components. The meeting I just described can be the root of the next problem. So I've told you to align to business objectives. You've aligned to business objectives, but the company has a lot of different ones. And so now what do we have? Well, we have a revenue goal. We have a margin goal. We have a new customers goal. We have hey, we need to add training to every deal because we find that well-trained customers stick around with us longer. Oh, marketing just told us that we've got a brand new product coming out next quarter, and we want to really hit the market hard on that one. Products just told us that they're also doing an upgrade to a product. We need to get the old stuff out of inventory, and we start adding components over and over and over again. So here's an insight I want to share with you. We took a look at this I wrote a hypothesis, and I said, I have a hypothesis that once you get above 3 measures, you start losing your performance. Now, I did this based on my experience back as a compensation consultant. We used to always tell our customers 3 measures is the max. And there are psychological studies that will say that you can only keep 3 things going in your mind at any point in time. Too many, that is a distraction. I assumed that worked also in sales, and it was proven to be true. We found that the best performance came when you topped out at 3 core measures, and that we found that each time companies were adding another measure to the compensation plan, the number of measures where reps were hitting the goals, the stated goals in the plan, started dropping. You distracted the reps, or they would choose 1 or 2 to be their favorite ones to achieve and ignore the rest. That seemed to be the standard. You still had reps that are bringing in business, but they would say ignore the training spiff because it just was too much for them to keep an eye on, and they just focused on a few that worked. So you've got to make sure that you don't throw too many measures out there, or as this mentions, you throw out these measures because instead of just walking and sitting down with the reps, hey, you need to make more phone calls this week if you're going to build up your pipeline. Instead, we suddenly add a plan component for making phone calls. Well, you shouldn't pay people for activity. Ken Krogh at Inside Sales likes to talk about that a lot. He's a good friend of mine, and he blogs over at Forbes, and he'll talk about, paying people for activity is not the idea. Tracking the activity and coaching them through it is what you want to accomplish. So how do we fix this sin that comes in? Because everybody deals with this at some point. You get this creeping in. focus on the 3. That's why in the prior section I said, hey, let's sit down, let's work at the whiteboard, and let's make this happen. And then let's choose the top 3. And if someone says we need to add one, determine which one can you drop. Which one isn't as critical for this particular quarter, this particular period, and that way you don't get into that trap. It'll also keep you focused on what's really important. You know, your company probably doesn't have 20 things that are important. It really probably has just 2 or 3. So let's move on to the next one. So now where are we? Well, now let's talk about oversharing the wealth. Who, in the audience, if I'm making this a polling question, I'd love to have that to ask you, how many of you sat in that meeting where all of a sudden it seems that everybody had a piece of the biggest deal you just closed? All of a sudden you've got the rep was there, you've got a sales engineer that was there, of course the rep's manager helped close the deal, you had finance involved, maybe someone from the partners and alliances team got a piece of it, you had the person who keeps track of all of your customer references had a piece of it, and we're thanking everybody for this, right? Well, where does this end up leading? Once you thank everybody for a while, and then suddenly someone says, well, gosh, maybe this should be part of everybody's incentive compensation plan. We should make sure that we're appropriately assigning credits for any given deal. And this is where the problem of oversharing the wealth comes in. And it's how many checks do you cut on a single sales deal. We have seen on one deal 161 different checks get cut. Now, in some cases, this does include, say, the commission, the commission for the deal, the quarterly bonus check, and the annual bonus check. So there could be 3 in one rep, I admit. But 161, and this is where you see these roll-up credits where the frontline rep got credit, their sales engineer got credit. Maybe they had a subject matter expert as well, a 3-person sales team. Then each one of them had a manager. Each one of those managers had a director. Each one of those directors had a vice president. And all of a sudden, we start adding credit after credit after credit. The problem here is you're probably overpaying after a while. And even worse, any given action or activity doesn't lead to performance. And what you're really getting is what I call a reward, not an incentive. A reward is something you get after the fact that reflects what you did in the past, and you say, thank you very much, company, for recognizing my work. Nothing wrong with rewards. They can be an effective tool to use to reduce employee turnover. An incentive is something that I know that if I get up 30 minutes earlier and head into the office, I can earn some more money. With a reward, it's an after the fact, thank you very much. An incentive gets me to work harder, it gets me to work smarter, it gets me to come in earlier, stay later, take a shorter lunch, not spend as much time in the break room, etc. I do deals for incentives. I'm just happy when I get rewards. If you are overpaying, you have a reward system, not an incentive system. So how do we fix this? Well, if we start taking a look at this, 75% of the companies pay 5 people on a typical deal. That's actually a really good benchmark for you to take a look at. Take a look at everybody you credited on a particular deal. Make sure they really deserved it. Make sure it was driving behavior and driving performance. Make sure you're not diluting your incentive dollars by spreading them so thin that no individual action or activity is going to get your employee to do a little bit more, to work a little smarter. That's where I want you to go with that. So this will be a great exercise here at the end of the year. Back up, pick a couple deals and back trace them and see how many people got paid a little bit on those deals, and ask yourself, did that change any sort of activity or behavior? So now let's talk about even worse. So worse than a reward versus an incentive is something that's actually a demotivator. Believe it or not, we can write an incentive plan that disincents actions or behaviors, that convinces a rep, don't work that hard. Don't do what the company needs you to do. And so what are we talking about here? Well, the biggest issue in incentives is pay me as quickly as possible for my actions. That's how we keep it an incentive. In a perfect world, if I sold and collected cash for the deal, you would just simply hand me back an envelope full of the cash. You want to go as close as possible because that's what convinces me as a sales rep to go out and do it again. So holds and releases. This is where the rep has booked the deal, the paperwork is in. Maybe it's a net 15, and we'll pay the rep when we collect the money. That's good. But maybe the money is going to come in over the course of the next year because of our implementation or installation. So we trickle the rep's money in over the course of the year, holding their commission checks. Guess what? That's no longer an incentive. My line of sight. All of a sudden, there's just more money in my direct deposit account. I actually think that we've lost a lot now that everybody's on direct deposit, and how many people even open up their envelope with a pay stub, or even worse, it gets emailed to them, and they don't even notice it. They just say, hey, cool, there's some money in my bank account. Oh, right, that's because I closed the Smith deal back in January. We're back to not having an incentive here. Next, caps. Everybody has the story of the rep that had the perfect bluebird fly into their hand that they walked into the company, and they suddenly made $1 million. And so in response to that one deal 10 years ago at a different company, we put in a cap to keep those sales reps from making, quote, too much money. Don't do it. As much as possible, do not write a firm cap into the compensation plan, because what you're telling your reps is stop working if you're anywhere close to the cap. They won't work all the way up to the point of the cap. They'll stop at 85 to 90% of the cap instead, to be absolutely positive that no deal they bring in results in lost commission dollars because of a company cap. It works as a demotivator and a disincentive. I'm not saying you shouldn't have some legal text somewhere in your comp plan that says the company reserves the right to play around with credits in case of an insane deal. But if you actually say we only pay up to a maximum, say, of 300% of incentives, you're telling the reps to stop working at 250. And that's going to cost you business. It's going to slow you down. Worse, if you're in a competitive industry, you might not ever recover that particular opportunity. And then payment timing. I already brought that up. Pay as early and as fast as possible. I've had companies ask me, should we wait until we collect the cash? And I turn it back on them. I said, I don't know. How often do you not collect the cash once your reps close the deal? I said, oh, never. We're at 100%. Then why don't you go ahead and pay on the booking? If you're telling me that your booking to collections is 100%, you should pay the reps at booking. Get that money in their hands faster. I know it drives finance insane. Sorry, and I'm talking to a finance audience here, but it drives better performance as well. Pay as early as you can. At minimum, tell them what they burned. Even if you don't write the check, give them a report that says, fantastic, you closed this deal, you've got $3,223.17 coming to you in your next pay period. Isn't that great? You'll get it on, on November 1st. That makes for a happy rep and to go out and close another deal. I've kind of gone through most of so drop the caps, drop the holds, and pay on time. Months in arrears is really bad. A very good friend of mine is a director for the Western United States for a very large enterprise software company. And he gets paid a month and a half after the quarter end close. So if you think about that, let's take a calendar year. He does a deal in January. He gets paid on April 15th for that deal. There is no motivation there for him. Even worse, he doesn't even know what he's going to get paid. He says their math has never matched up to his, but they pay him well enough. So let's keep going here. Now let's talk about profits, the next big issue. How much are you, now that I've talked about I want you to pay early, pay often, pay smart, reduce the measures, now we've got the other direction, though, of weird payouts that you never saw because you didn't project, you didn't accrue, you didn't throw up any sort of a fiscal model. And so this is those unexpected payouts to your reps that happens oftentimes with accelerators. I love accelerators. Accelerators are the things that say when you're above quota, you get paid a higher percent. Or even more, maybe from 0 to 50% of quota, we pay you 3%. From 50 to 100%, we pay you 6%. From 100 to 150, we pay you 7%. And every deal above 150%, we pay you 8%. Pretty standard one. And then sometimes companies throw out some huge payouts at 2 to 300% of quota. Sounds great, but if I'm suddenly paying 8% and our product margin is around 9% and our reps have a lot of influence on the pricing, I can suddenly find out that I've got reps running into accelerators who are actually paying a ton of money out. They're bringing a lot of deals in, and we're suddenly paying more than the deal is worth to us. I've watched that in a lot of companies, especially ones that pay a flat amount for bringing in a deal and even more for bringing in extra deals. These are companies that were just hunting logos. They wanted more new customers, and they found that they're actually paying more in commissions than the margin on the particular deal. Another one is if on those accelerators you pay back to $1. So that is each time a rep moves up a notch, every single deal in the past gets paid at that higher rate, and if you weren't anticipating it, you get caught. Think back to that quota distribution graph I had at the very beginning of today's talk, where it's not a normal curve. And if you sit there and say, hey, last year on average, we were at 103% of quota, and then you go and you write your fiscal accrual model based on 103% of quota. But if you've got heavy acceleration above quota, and you've got reps that are in that 200 to 300% of quota range, and a lot of reps that don't get anywhere close, guess what? You paid a lot of accelerators to your rock stars, and they are not counterbalanced by the money you saved on the people below quota. The math doesn't quite work out. Your mathematical model for accruals really does need to reflect the fact that you're going to get a spread spectrum of performance. This is I'll even go a little further here, back to that quota distribution model, and this is who remembers the Pareto rule, the 80-20 rule. 80% of something is always brought in by 20%. We know this for a lot of people. Of 80% of revenue comes in from 20% of the customers. Las Vegas is all about that. They know that there are the whales that bring in the most of their profits. And the whales are what really pay for everything, and the rest of us that are playing at the cheap tables, we don't really pay the bills for the casino. Sales is the same way. This was another thing that we took a look at. We analyzed through our entire data set what was the rule, and we found it's actually almost dead on that about 80% of revenue comes from 21% of the sales reps. And even more if we just looked at sales reps who'd been around for more than 1 year. So we had, they were in their second year, so we were ignoring all those new reps that used it higher and then don't make it. It was actually 33% of the sales reps bring in 80% of the revenue. Well, that 33% is in accelerators that they're earning, and everybody else is into the lower level. And if you've got a lot of juice at above quota, you're going to spend a lot of money, and it's going to impact your margins. So when I say, the budgeting, what do you expect sales performance to be? Make that quota map. Take a look at your Pareto rule. See where the distribution is. Do a few performers nailing it cost you a lot of money? And are they gaming the system a little bit? This is one where I've seen this. There was a plan, Chad Albrecht from ZS Associates likes to tell the story of a client that ZS had. And what happened was they had a monthly commission plan. And if you were at 200% performance, you actually got 300% of your incentive. So great little, bit of accelerators to really drive behavior. A few of you are probably nodding your heads. You're seeing the problem here. What it was doing is it was driving reps to sit on deals for 1 month and bring all of them in the second month, so that 1 month they'd be at 0%, the next month they'd be at 200%. They would hit that 300% incentive accelerator, which meant averaged over the 2 months they were at 150%. There's no way for the company to actually model that out to keep their numbers clean. It was messing up with the financial accruals. Luckily, they changed the compensation plan so that they wouldn't get too caught in this, but that's where some of these challenges come in. So what do you expect your performance to be? How are you going to deal with people who are way out there on the edge? We like those people. We like the rock stars. Rock stars pull everybody else forward because people want to learn from them, and they go to the rock stars and say, hey, can you give me some advice on this account? What works, what doesn't work? But at the same point, you need to be ready for them to be earning huge incentive amounts, hitting their accelerators, so that you've got your accruals down so you don't get caught by surprise by misstated earnings. I actually have seen that. Last year there was a publicly traded company that had to restate earnings, and their reason was unforeseen compensation expense. And what it was is they had a good quarter, but that good quarter was thanks to 1 or 2 deals, and it triggered such a high level of payments to certain sales teams, and they hadn't accrued for it. So that brings us even further into measurements. How do you measure success? How do you know if this is all working for you right now? So you've got our gut. You've got maybe empirical evidence. You've got experiential evidence. Maybe you've even read a few academic pieces. You need to base it on data, not intuition. You heard me earlier when I talked about the 3 measures. I said my hypothesis is that 3 measures work. And my experience was that 3 measures work. But I never tested it against data. You really do need to get into the data game with sales. as much as people want to say, hey, sales is an art, it's a personality test, it's all of that, absolutely. The design of a good sales rep, and there's lots of companies that get into this concept of how can we figure out who is a great sales rep is out there. But when you're building a comp plan, there is data. So there are benchmarks you can run. And yes, exactly off for some of these benchmarks, I'll admit. So you should be pulling sales compensation surveys. You should be seeing, is your incentive plan too rich or not rich enough? I was talking to one company, and they took a look at where they were spending their accelerators, their over and above performance dollars, and they actually spent a lot of money on it, which they thought was great. They took a further look, and they realized that the majority of those dollars are being spent on first-year sales reps, because what the company was doing is bringing in new sales reps, giving them a lower quota to help them ramp up. Those reps are all blowing out the quota, earning huge accelerators, and then the next year they were going in and getting a more legitimate quota, and then they were wondering where all the money went, and then they would have turnover, and they'd start over again and go hire another brand new sales rep. So we said, well, let's take a look at first-year guys. Maybe you're benchmarking this, and your percentage of quota that a first-year rep gets versus the level of quota that an experienced rep gets is too divergent. Take a look. Where's the money going for you at any point in time? What is your pay mix? Pay mix is a great one to take a look at. What percentage, that's percent of target earnings in salary versus percent of target earnings in incentives. That has changed over time in a lot of industries. We've even looked at it even further. I've done some research with Professor Alan Benson at the Carlson School of Management, University of Minnesota. And Alan found it was very interesting that the more pay mix, the higher the pay mix, the more percent of my pay that's variable, actually results in both top reps ramping up faster when you first hire them, and other people quitting, self-selecting out, no longer being in the system. Kind of makes sense. If you think about it, let's go to the far extreme of a 100% commission sales job. If I'm not closing any business, I'm not paying my rent, I'm going to quit. But the rule continues to work with percentage of pay mix. It's a really good one to keep an eye out for if you're trying to ramp people up. So that's another type of benchmark. What's your pay mix and how do you keep it going? I've seen some great sales plans even that go even further, and what they try to do is, there's an incentive to encourage the rep to get off of a draw, as in you can't earn accelerators while you're on draw, for example. So the sooner the rep can get their business going, the sooner they get off the draw so they can earn the higher commission rate, they can earn the accelerators. So you want to look for that one. Check your particular industry groups. There's a lot of good data out there for industry groups, even just self-benchmarking against company goals. What do I mean by this? Well, take a look and see what you've paid out for individual deals, perhaps tied to individual products. Is it going to where you need it to? These are all the different numbers games that you should be playing. And even it's not too late to start right now, but then once you build a few of these models, a few of these things you're looking at, then keep track of them over time. I did a short 2-minute video earlier this year that talked about, some reports you should be looking at any point in time. I always say you should look at quota distribution, but one of them is the scatter plot of incentives, target incentives versus target quota, and just putting the dots up there. Now, it should actually reflect your compensation plan, but it's amazing how you can sometimes see some dots where somebody is at only 60% of quota, but they're at, say, 150% of their incentives. How'd they get there? Well, we like to do contests at this company. We like to throw out a spiff or some sort of other way for someone to earn some extra cash flow, and these are the few reps that have really figured out how to game the system. There is nothing wrong with gaming the system. It's a great place to be. It means your reps are actually paying attention to the incentive plan. And, I've been asked, what should I do with that rep that's doing that? And I tell them the perfect punishment is put them on the sales compensation plan design committee. This is someone that reads it, and that way, as you are designing the comp plan, you turn to that rep, your game player, and say, so how would you manipulate this plan to make the most amount of money? And as they tell you those answers, you decide, is that worth it or not? Them being at 150% of incentives because they chased the spiffs, but if then you say, yeah, but he's the only person that sold our brand new product, that's a good thing. You might as well run with it. You might as well chase it and embrace it. So I have no issue with people who play games. Our CEO is actually publishing a book on gaming the plan later this year, so you might as well go down that model. So let's keep going a little bit. And we're getting into our next polling question.
Okay, great. Thank you very much, Eric, for that compelling content. I've gone ahead and launched our second polling question. Our second polling question is asking for a high-level assessment of your company's controls and auditability of your incentive compensation plans. Again, those of you after CPE credits for today's webinar, we need to answer all the polling questions during the webinar. And again, we appreciate everyone's consideration in answering all of our polling questions. Again, we hope this question inspires more of your question. We have a great expert today, and we want to take full advantage of the opportunity to ask him all of your questions. And we encourage you to ask questions on today's topic via the questions box in your GoToWebinar control panel. Again, I'm going to leave this polling question up for another 10 seconds or so, and then I'm going to hand the floor over to Eric and get his comments on the audience responses, and then we're going to let him continue on his presentation. And then we'll close off with our Q&A session, which will include our final polling questions. So I'm going to go ahead and close the poll. And now I'm going to share the poll and get your comments, Eric. Eric, the floor is yours.
All right, fantastic. So let's talk about this, controls and auditability. And this really rolls back to everything I've been talking up to prior to this, which is all these different ways of, we spent this much money, did we get our money's worth? And before I go into this, back when I was a consultant, I remember designing a plan, a matrix-based plan for a company, and where on one axis I had return on assets, is how well were they leveraging their existing assets, and the other side was just straight revenue increasing. So they had a goal to hit a certain ROA number, and then they had another goal to grow revenue. And depending upon where the intersection of those two lines were in a matrix of payouts determined their incentive payout. And to lay it all out, we went through it. We modeled out the fiscal impact of every single place on that grid. I mean, for every single one of those, I told the company, this is how much money you will spend. Are we good with this? Each time they agreed, yes, yes, yes. And then I helped them with the communication materials. 3 months later, I got a call from that client, furious with me, because at the end of the first quarter, they were in this case, it was the bottom right, was the highest payout point. They were paying 300% of incentives, and they told me that I had messed up the consulting engagement. They wanted me to come back and give them another engagement for free to fix this problem. And I just asked them, I said, hold it. Are you telling me that your return on assets is higher than it's ever been in the history of the company? Oh, yes. And are you telling me that your revenue growth is twice that of last year's? Well, yes. So you're calling to thank me, right? And my personal choice is a 21-year-old Scotch, maybe a 21-year-old Macallan. You know where my office is? Have it shipped to me. You're very welcome. We laughed about it. I wasn't quite that arrogant, I promise, but that was what was going through my mind. I actually did get the bottle out of them, but they did what we wanted them to do because we were able to trace it and audit it. So let's take a look at this. The auditing of the incentive compensation plan. If I said, could you show me every person that got paid off of that deal? Do you know that it happened? Could you show me, that for any given dollar of revenue, this is what our true incentive cost was for that particular dollar of revenue? We broke out SG&A into just the variable incentive expense and actually tied it back so that we booked the variable incentive expense for the exact same period that we booked the revenue, which I'm sure everybody's doing. Could we really take a comb through that and find any issues or concerns? How often do you have to go back and recut the checks? Gartner has talked about this going back for 15 years now, from the first time they started studying incentive compensation management software systems. Their first report they ever wrote, which I think was in 96, 97, they said there's a 3 to 8% error rate in compensation checks. And actually in a report about 4 or 5 years ago, they said it's as high as 10% at some companies. They've gotten this out of their client base. And I always like to say, okay, let's take 5% error rate. Let's lowball this. If you have a 5% error rate in your commission checks, which ones do you hear about? Well, I'm going to bet you hear about the 2.5% where the rep got underpaid. That's when the rep is suddenly requesting a meeting with finance. Now, you may or may not, depending upon the attitude of your sales reps, hear about the 2.5% overpayment. But at minimum, if you'd like to get a feel for what the problem is with your auditing system, just do one check of how many commission checks did you have to rerun last period because you underpaid everybody. Take that amount of dollars and double it. That's your error rate. That's a good, damp finger in the air, as I'm sitting here talking about extreme traceability, but damp finger in the air guess. It's a ballpark guess. And if you didn't go back and do clawbacks on reps for where you accidentally overpaid them, you are wasting money. And 2.5%, 5%, 8%, if we back up again to what's your company's ROI in general, what's your net income? And if I told you that, you are, misspending by that percentage, which is impacting your bottom line, what could that do if you fix that to your overall company's profitability? So this is where controls and auditing is so important. And the folks admitting that they're somewhat week to week, yeah, I've seen that. Oftentimes that's because you're paying off of spreadsheets. You're sitting there in a, excuse me, an Excel database to manage incentive compensation, which sounded great when you first got it started. And I love Excel. I've taught Excel classes at extension programs. It's an amazing tool, and Microsoft had me consulting with them at one point on their stats stuff, mainly because I was harassing their product manager about an error rate back, if you remember, back in Excel 3.0. They had some issues with it. But that's a different game. Excel breaks once you get too many sales reps, and you start needing a better system because you find yourself copying all the formulas from one tab, putting it into another tab, and you don't know where the little errors are creeping into your formula. And even worse, it might have been a formula written by somebody else. And the truth of the matter is, I will let you benchmark right now. 80% of the market is still using some sort of a manual system, if not higher. It's depending on whose numbers you want to trust. And by manual systems, I mean it's an Excel or an Access database, or even people that will admit, this was in a CSO Insights study, that they still hand calculate. So with that, let's jump to the seventh sin, and then we'll get to your questions. And again, while Ernie's switching this around up on the screen for us, I want to remind everybody that for the Q&A, enter them on the question panel there, the GoToWebinar question panel, toss it in there, and we will get to as many as possible as we can before the top of the hour. So lack of traceability to sales behavior, as in, I know what I paid, I know what I brought in, can I draw a very clean, distinct line between the two? And let's see here. Trying to get the page to shift for me. There we go. Solid foundation of, whoops, I was afraid of that. Sorry, everyone. I did click one too many times. Thou shalt have a solid foundation of data. Thou shalt be able to say, we just closed the Simpson deal in Springfield. Who got paid on it? How much did we spend? This is good. This is bad. You must be able to dig in and easily find that data. You want the auditing clean. One of the things we love to do it exactly, I will admit, and our clients talk about this, is because in our interface, reps can log in from an iPad and see every deal they've gotten credit for down to the line item and the money. The reps become unpaid auditors for the finance department, because they take a look at something and they say, hold it, I didn't sell 100 units to Simpson of Springfield. I sold 1,000. Probably just a miskey from the invoice to the finance system, which does happen. And the rep catches it first before you've even shipped the product, before you've done anything, because it impacts their commission plan. And we actually have ways for reps to press the button, and it goes to the compensation administrator and says, hey, there's a problem with this one, and the rep types in a little text of, that's supposed to be 1,000, not 100. Or the pricing was $13.76, not $1.36. I mean, so many different ways of playing around with that, and the reps become auditors for us because, of course, they care about their compensation plans. Now, are they going to catch if you overpaid them all the time? Maybe, maybe not. But putting more information available to the reps, to being able to audit from the comp manager. One of the interesting challenges is when you come in and say, hey, how much did we spend on this deal that was, 2 quarters ago, and you've changed your sales territories. Having date and time stamps on every deal, every credit for every deal, and every commission dollar ensures that if you need to back up into that, you can really find who was doing it. Lots of different places around here for the numbers. You want your numbers clean, or you're going to make projections, you're going to make assumptions going in the wrong direction. You're going to build a comp plan structure that doesn't work. So what you want to do here is, make sure that every incentive dollar can be traced back to a business deal and traced back to a behavior we're actually trying and successfully driving towards. Remember, what's the goal of the compensation plan? The company has objectives that it needs to reach. There are behaviors that will get us to those objectives. We want to incent those behaviors. If the company's goal is to expand into Europe, then we need incentives that reflect the fact that we will pay 25% more for any deal in Europe so that we can run a press release saying that Company X has expanded into the European marketplace. If our goal is market share, the classic cola wars of Pepsi versus Coca-Cola, then we need to be able to measure market share, and we need to pay on market share, and that needs to be one of our top 3 measures. That's our goal. 1, 2, 3. Do we want to do it? Can we measure it? And are we paying for it? Now, if you can't measure it, you shouldn't pay for it. It's that simple. The numbers should be clean enough that you are confident telling somebody you do not deserve an incentive check because you didn't do what we wanted you to do, because I can look at this report and see that nothing happened. You've got to keep that clean so that there is no argument about the commission check. Leave the arguments to what's my territory. Leave the arguments to why can't I sell into these larger companies, or leave the arguments to why is that company now a strategic account and no longer in my patch. That's a fine argument to have. An argument over, I did this deal and it was this much, why didn't I get credit for it? That is wasting sales time, and it's wasting finance time. I'd rather sales was out selling the next deal. I'd rather finance was actually working on reducing our CAPM. So all of this, what am I looking for here? Incent right. I want you to be able to nail it. I want you to get everything you want from your dollars so that every penny we spend on incentives, you actually get a return on investment for it. I want when someone says, hey, how does this look? I want you to be able to open up a quick report and say, it's right here. We know what happened, we know why it happened, and we know how to make it happen again. So with that, I'd like to say thank you very much. And we'll start rolling into the questions.
All right. Thank you very much, Eric, for that great content. So, we'll start our Q&A session now. Again, if you have any questions, please enter those into the questions area and you go to our webinar control panel. First question, Eric, is what financial data should I use in developing incentive commissions?
The answer is all of it. This goes back into what are your company's goals. So I've seen the ability to know whether or not it's a new account or not is a great one, especially, again, if you're trying to expand your presence. Followed by, of course, the revenue on the deal and the margin on the deal, and then the specific product sold on the deal. Those are 4 of the first few. Being able to identify what type of an account it is and where it ships to from a variety of, for territory management measures is really important. Being able to know, do you have a problem of products being returned or reps overselling a particular product, for example. So if they're selling a product that shouldn't be used in the way that it is, and a lot of those are being returned, and you're losing the business, that's a bad thing. And being able to measure that is critical. But let me back up to my first example. We launched a new product exactly a few years ago. And because we wanted just to get into the marketplace, get referenceable customers, get people using it, we paid a flat amount for every closed deal. And then after 1 year, we shifted our model where the reps actually got paid on the revenue in the deal. And our revenue in that case is dependent upon the size of the company. The size of the deals doubled the next year. First year we paid them for bringing in new business. They brought in some small businesses. Next year we paid them for the size of the deal. They started bringing in larger businesses. The reps did exactly what we paid them to do. Now to manage that, we had to know who was a new deal, and we had to know how big they were, obviously, and so we had to track that. Another company I've seen where what they did was they did a quarterly revenue payment, and every month, that was a nice one because what it did was, in case the rep really was in a nasty pricing battle with the competitor, the rep might lower the price to get the revenue bonus in, even if they lost their commission amount, and they did have to consciously decide to give up that commission amount. They still hit the revenue number, and the company didn't sacrifice market share. But again, you couldn't do that unless both of those numbers were something that were.
Next question. When someone works at a multinational corporation that has operating units in several countries and sales and even more, do you recommend a one-size-fits-all compensation plan, or do you advocate a sales plan that is tailored for each country?
I would say you want a sales plan that is tailored to each market. It doesn't actually matter if it's a country or not. Sometimes different markets are just different. Manhattan is different from Tulsa. Each one has its own unique characteristics and its own unique buying cycles and its own unique customer base. When you get into the, and for example, selling to the federal government in the United States, they're on a different calendar fiscal year, different buying cycles, and certain things that impact it. When you go into different countries, you still have the same goals. You're also going to have to look out for actually some of the tax laws, as I'm sure many of you are aware, of when you're allowed to pay certain levels of incentives in certain nations. That can actually impact how your plan works out, or at least depending upon where your rep is based. Now, it is good to reconcile in a single currency and make sure that your incentive plan does the same sort of currency transitions that you're doing for how you book revenue, income, and expenses as well. Looking at some of the nations, I see it more as, is it a new market or an existing market? You might adjust, again, territories and quotas based on that marketplace. But if you have an overarching company goal, that should match into each of the marketplaces. But I see it as a market, not a country question.
Okay, great. Thank you very much. And so you've done a great job of outlining the 7 deadly sins. I've got 2 questions along those lines. First part is, what is the most common mistake? And then part B would be, what is the most costly mistake that people make?
Most common mistake, I would say, is an unclear compensation plan. The reps really don't know how to make the most money. They know they're supposed to sell, but they don't know how to maximize their earnings. And that's coupled with a late compensation plan. I've seen companies that don't get the plan out until March, if they're on a calendar year, and they're wondering why Q1 is always weak for them, and they need to play catch up. So a clear, concise comp plan. Here's my favorite test of that. Walk down the hall of where your sales bullpen is. Look at somebody and say, hey, how much are you going to make this quarter? If they get a little fuzzy-eyed when they look at you and they say, I'm not too sure, hang on, but I keep a spreadsheet on my laptop where I try to track everything, you don't have a clean compensation plan, and worse, you have a rep wasting their time with what we call shadow accounting. So, these hyper-complex comp plans that are drawn by the math PhDs do not drive rep behavior. Reps want something that says, if I go do this, I make this much money. That's the goal that you want with your reps. That's how you want them operating. Now let's go down the other direction. What's the most costly? It's a combination of overpayment, and by that I mean that 161 checks written for one deal, and followed by driving the wrong behavior. Paying me to sandbag, paying me to hold on to deals, paying me to push unprofitable products because you didn't realize that was the easiest thing. So that's the next one. It's the perverse incentives that you can run into out there. I mean, and you can go back to some classic stories of, call centers where we paid people on the number of calls they took in a day, so they hung up on customers, or farming-style reps who were not paid for renewals. They were only paid for upsells, so they were cramming the customers with services that the customers really didn't need because of the only way they got paid, which then led to lawsuits and or cancellations of contracts. So reps will do what you pay them to do. Beware.
Okay, great. Thank you, Eric. Someone is asking a question around your advice as to if you have an annual sales incentive plan and the plan is clearly not working, how would they transition that or make changes to that? Or I guess the side corollary is how do you develop an incentive compensation plan that has some flexibility to react to changes in the market?
Set quarterly goals to begin with. Start with thinking on a quarterly goal basis. And the great thing about quarterly goals is quarterly goals actually drive higher performance out of mid-range reps. The top reps respond no matter what. The mid-range reps, when they start looking at the end of the quarter, will oftentimes step up their game more than a top rep. This was actually backed up, validated by Harvard Business Review. They did a whole issue on sales comp about a year and a half ago, I think. They had a carrot on the cover. I can remember the copy of the magazine, but somebody in the office stole my copy of it. And if you go in there where they found that a middle-of-the-road rep would try to win a quarter, even if they felt that they never had a chance of winning the year. So quarterly goals are a great place to start. And if you have quarterly goals, it's much easier to reset the goals each quarter. What you don't want to do is reset goals after I tell you, here's your annual incentive plan and your annual goal. And if I come through and change that halfway through the year, yeah, you're going to get some pushback. You're going to have people saying, I have been building a pipeline to hit my annual goal, because I'm a typical sales rep who, if you tell me it's an annual goal, I chased all my business in the last month of the year. If you build quarterly goals, it's a lot easier to say, hey, we're at quarter end, next quarter, this is what we're chasing. And then it's a lot easier to re-communicate that.
Okay, great. I'm going to go ahead and launch our final polling question as we wind down the Q&A session. It's going to be asking to identify the biggest pain point in the arena of incentive compensation at your company. Our next question, Eric, what percentage of a salesperson's total comp should be paid in commission? Is there a general rule of thumb, or should you benchmark that by industry?
You should absolutely benchmark that by industry. I'm seeing more and more 50-50 plans for reps that are selling into corporate enterprises, and that is a higher percentage than I saw in the past. There seems to have been a shift over about the last 15 years. Plans that were 70-30 have become 60-40 plans, and a lot of 60-40 plans have become 50-50 plans. So I'm definitely seeing more of that, but I would say that's a great one for everybody to benchmark and check in your industry. And again, remember, if more pay is at risk, you will attract better reps, and there's some academic research on that having good pay-for-performance plans attracts higher quality candidates, and then our own research has shown that it convinces poor performers to drop out faster as well, but there is a transition period that you'll run into there, and you also run the risk, remember what I said about make sure you're forecasting your costs, because if you've got a high variable incentive program, then when you bring in that revenue, you're going to have to pay for it. Now, I don't mind paying for revenue that is brought in, but those of us if you're on the finance side, you certainly want to be ready for that cost.
Okay, great. Thank you very much, Eric. I'm going to go ahead and close the polling question, and then I'm going to go ahead and share the results in a moment and get your thoughts on that for us, Eric.
So gathering data is certainly a challenge. On many of our implementations, we'll find ourselves pulling data from 2 to 3 to 4 to 5 different data systems. There's no reason not to be able to do it, and it should be an automated process of some flat files. It's just a matter of working with a combination of IT and finance to get in all the right transactional data and clean it up to make sure we get the right credits and the right movements in there. And there's all sorts of fun challenges. I remember having a client where one of our issues is we had to back out. They were doing a really good job of managerial cost accounting, so they had costs in for every single product they shipped out, including the cost of the cardboard and the cost of the shrink wrap, and we had to make sure that nobody got paid for that particular financial number that was assigned to a deal. And that was just because of how the data came out. Running and verifying the calculation, same issue. This is typically an issue when you're sitting here in some sort of an Excel or an Access database that's been built by one person who is the master of their domain. Only 5% of you talk about issuing reports as being the biggest pain. I know since we forced you into only choosing one, that doesn't surprise me, but it's amazing how effective better reporting can be. And then obviously we have the accruals and the others. I'll just want to talk about the reports. I have a flat screen TV hanging above all of my sales bullpens that is updated every 5 minutes of how people are against their goals. And let me tell you, it drives behavior. Ernie?
Okay,
We're
great.
at the top of the hour.
Thank you very much. Yeah, I didn't want to cut you off there. I'm going to go ahead and close the Q&A session. We'll coordinate with our speaker at getting questions posted on performative.com. Had a lot of great questions, so look for those on performative.com. Again, a few closing notes. Thank you to Eric for his time and insights. He's clearly a thought leader in his field and an excellent source on information on today's topics. Note in the post-webinar survey, which we prompted to take right after the webinar concludes, you have the opportunity to express your interest in being connected with Eric and or our sponsor with just a few mouse clicks. Again, thank you to today's sponsor, Exactly. A quick note as we conclude the webinar. The registration for Performer Tech's second annual conference is now open, and there will be a question if you'd like to learn more information about that conference, which is designed to help companies take full advantage of the current revolution in corporate finance technology to drive results across the enterprise. Finally, thank you to you, the audience, for your valuable time. We hope to see you again soon at another Performative event or online at www.performative.com. Make the rest of your day great, everyone. Thank you.